So today I thought we'd I had in mind that we would probably run through the euro and maybe the pound and anything else of interest. So if you have anything on your mind, let it let me know, and we can cover anything you want. The title of the webinar was to do with longer term time frames and multiple indicators. So that's kind of where I'm going to be focused for the most. And I wanted to just show how I use multiple indicators to build trade plans on the medium and longer term, basically. All right. And I don't necessarily trade a ton of intraday anymore. It's more kind of sticking with the longer term way of looking at things and then going from there. But we'll build them and go from there. So let's start with the euro. And I think it's an interesting time in currency trading in general. Not necessarily the easiest time, I would say, because of what's going on fundamentally. The Fed keeps giving us mixed signals, right? It's if you remember when Ben Bernanke was around, he said to us, well, when employment gets to 6% or 6.5%, then he's going to look to normalize rates. And then 6% came and went. And then Janet Yellen came in, and she was like, well, if it gets to 5.8%, we'll, and et cetera, and now we're at 4 and change, and we're still in the same boat. All right? They're normalizing rates slower than pond order. And it's, somebody asked me the other day, well, what about the Phillips curve? And really, inflation means nothing if there's no wage inflation, meaning that the economy is producing a bunch of jobs, but these folks are working at fireworks stalls over 4th of July, or Target is needing help at a distribution center, so they'll go get $8 an hour jobs at Target. And unfortunately, the US economy isn't producing copious amounts of those high-paying career-type jobs. And as a result, we've got almost no wage inflation here. And it creates a sticky situation, particularly for the Fed. All right, now, Europe isn't in a good situation. I mean, there's upheaval in Germany now, Germany. All right, but it doesn't have to be. I think it's important to realize that in currency fundamentals, it's all about who's doing relatively better and at what rate. All right, it's kind of, you don't necessarily have to be doing well, you just have to be doing a little bit better than expected. And then the money's going to pour in that direction. And the biggest Ponzi scheme in the world, otherwise known as Bitcoin, has been going through the roof because of the lack of confidence in both those areas, in my opinion. There's zero confidence in the dollar, and there's zero confidence in the euro, and the yen, and the pound. And as a result, people clamor for other instruments. And the Ponzi scheme known as Bitcoin is the one beneficiary of that. Okay, so my point being in all of this is the euro is recovering better and is strong right now, not because Europe is strong, it's strong because it's doing better than necessarily expected. And here in the US, things are a little bit slower. Yes, there's still a lot of retail money flying around, but there's also a lot of debt flying around. If you go shopping for flooring, they're willing to give you free money for literally 8 years to finance a $10,000 floor at like no money. So in other words, everything is once again going on credit here in the United States because this is a credit-driven society, aka a house of cards. All right? Net result of all of this is, if we say if we're saying to ourselves in 18 months, and it's an interesting question because I ask myself this all the time, in 18 months, where do we think the euro is going to be? Do we think in 18 months the euro is going to be at 130 or 107? Difficult. That's not. I could see it easily at either. My idea is that it's likely to be close to 130, but I think it has to visit 107 to get there. So if it dawdled a little bit, it could prospectively be 107. But I am ultimately bullish on the euro, just because I think the Fed's going to be a waste of time. All right. Now, if somebody said to you, in 2 years, we'll use a slightly wider sort of time frame because there is some Brexit involved. Will the pound be closer to 160 or 120 in 2 years? I'm thinking 160. All right, so my fundamental bias over that period would be up. However, I think that the pound probably needs to visit the early 120s to get to that level. Okay, so fundamentally, while I am dollar bearish over that period of time, I also do think that it's not just going to run up there, and that's supported by the long-term technicals too. All right, so my first indicator is always what I think fundamentally. All right, and then I can build some stuff from there. So let's look at the euro, and we've got a few little lines here. I apologize for that. Okay, so we'll start with a monthly chart and we'll work our way back. Even if you're trading on a daily basis, on an intraday basis, on a 5-minute basis, I really think you'd do well to zoom out and have a look at the bigger picture. And if you're not, you're probably doing yourself a big disservice. Guys, if you have any questions, I'm more than happy to answer them as you see fit. So throw them in the Q&A and we can slide over there and have a look anytime. It helps me with knowing kind of where we're going with things. All right, so here's our euro chart. And overall, is this an uptrend or is this a downtrend? I don't know. I think that's difficult. I know it sounds preposterous, but it's not obvious to me. You know, and if you did something like this, often, you know, I like to use this little chart format for determining, you know, it's just a little envelope, meaning that these EMAs are spread 5 deviations apart, so 5 to 10, 15, 20. And if you go to a monthly chart, they're saying down, but they squeeze together, so, you know, very neutral in the way that they're moving. But overall, down, okay? I don't want us to get, that's a whole lesson by itself, so I don't even want to get bogged down on that. It's just sometimes looking at that little envelope is a colorful way of saying, all right, what is the trend? And the trend's important because then you should look for sells in the context of a downtrend and buys in the context of an uptrend. At the moment, I'm euro bullish long term, but probably more bearish medium term, and I'm talking medium term in the next 90 days, and short term bullish. So I'm short term bullish, medium term bearish, long term bullish. That's, David, that's very complicated. You could. Anyway. So, monthly chart. Made a little triple bottom. running into this very significant area of resistance. It also so happens to be the 120 psychological level. All right, so it's likely that this is going to be a resistance zone. However, this is a monthly chart we're looking at. Anytime you're looking at monthly resistance, we might see 120.40 as where these little bottoms start to come in. But notice where these candle closes are. I zoom in a fraction. These candle closes sort of vary, don't they? Yeah, we touch the resistance solidly there. We penetrate through it here. Look at where the candle closes are, which is where this little bounce was. So really, it's a zone of resistance, and this could prospectively print something in the late 23s and still be in the resistance. Isn't it? Okay. So this is interesting to me because on this chart, it's looking to me like we should step up into that level and then pretty much count ourselves in that resistance to prospectively push down. All right, so in my mind, this is my monthly plan. And then I could see us bottoming out and trying to push up towards 140. And this is a monthly chart, so that is prospectively 2 to 3 years of trading. So for my money, I'm going to be loading shorts between 122 and 125. And then loading longs, anything below 110 for the long term. So in the broadest possible sense, that is my trade plan on that. Okay, once again, it's a monthly chart, so you've got to adjust fundamentals as they happen. They will happen slowly, but you can make adjustments of that. But in the broadest possible sense, that is ultimately my trade plan. So then it's a case of saying, right, what does this look like? That becomes more interesting because that's sort of the next 6 months. And here's where the multiple time frame jam fits in. There you go, me so far for the most, I hope. All right, so let's have a look at that sort of red box area there, which is probably what everybody's more interested in. Now, like I said to you, I don't think that the European economy is firing on all cylinders, but there is a lot of more positive news and feeling coming out of Europe. And if you read the last Fed statement released last Wednesday before Thanksgiving, Fed, Yellen was still very much pushing towards rate normalization and offloading their balance sheet, but then other voting members were saying how they think that this recent bit of inflation or downturn in inflation is supposed to be transient. But other voting members are saying, well, hang on, maybe it's not. The truth is maybe it's not, because the US economy is looking like a mirror of Japan. And the Japanese can print money until they are blue in the face. The wealth effect does not work. It makes wealthy people very wealthy and does very little for anybody else other than destroy your currency. And the only thing holding the US economy together is the fact that the dollar is the base currency of the world. And if they destroy the dollar to such an extent where other people start to accept other currencies in payment for things, the US is in big, big troubles. The biggest of troubles. The majorest of troubles. But that's a completely different discussion too. Anyway, here's our euro. Stochastics pointed up a little bit. Let's go back to that monthly. Monthly kind of at the top. So these are actually, in my mind, even though that's the only oscillator I use, these are still bullish stochastics, because this is something that we could see, this is something that we could prospectively see kind of cycle down a fraction and then kick back up and then roll over, which is what you normally see. You know, almost something like this. But it goes, I think. All right. And what that would do is create a second wave to the upside and then push down. Because we've hit some resistance. I just don't think we've hit the major zone. It was just a lot to deal with at once. The 120 handle and this piece here from 2012. All right. So let's go back to our weekly. The weekly is in a shorter term uptrend. And this is significant because there's going to be more people willing to buy in the context of this little uptrend, even though we know that there is major resistance through this zone. Okay, so let's put a little red dot there to remind ourselves that that is serious business through there. Okay, we'll just leave that there permanently. And, you know, these stochastics are pointed up, but I could see them, you know, doing one of these numbers. And I don't know if I don't think in my mind, prices reacted enough off that zone. Yeah, it came down to this first bit of support. I don't think that prices reacted enough off that initial resistance to have enough energy to be able to break this first zone to push up to 123. It's like thinking, you know, to put it in juvenile terms, if this is the castle wall, and here is the door. You know, this is the door to the castle here. I don't know. Turrets and things. Okay. And the man with the battering ram here, and this doesn't, I don't want this to, I was going to draw a battering ram, but then it made me think that that might get me arrested for something that looks rude. So, if you were going to break this door down, all right, would you want to do that from 10 feet run up? Or would you like to run and try and break that door down from 20 feet? Obviously, you'd have better shot from 20 feet because force equals mass times acceleration. And you would have a better chance of accelerating quicker into the wall with 20 feet of run up, assuming you didn't get tired in the 20 feet, rather than the 10. And the same kind of thinking applies here. You know, I don't think, given the amount of resistance we've had, that we can go and break that 120 zone immediately without a slightly bigger run-up. So that's why I think that we're going to likely step down closer to 115 and then try and push up to that zone. Okay, and if we take a fib of this rise, go all the way to the bottom. 114.27 is the 382. If we take it to the swing, then 15.13 is the 382, and the 50% happens. The 50% is closer to 13.50, which also happens to be this cluster of highs here. Okay, so we know we have a little bit of fib resistance / support at 15.12, and then again at, we'll call it 14 for argument's sake, which also happens to be these highs. And arguably these stochastics are still down. I know that there's been a little turn up, but I don't, you know, to me, I actually like looking at stochastics almost in retrospect, meaning that if they were like this, I would say yes, those are up. But just turning up at the bottom, I don't consider those up. I actually consider these still down. So the monthly I have is still up, but the weekly, I consider them still down. All right, now let's look at the daily, which are no doubt up. Yeah, daily's kind of crossed up and at the top. And this would be an example of what I saw on the weekly just on a daily basis, right? So on a daily, even though they were pointed down here, I would still consider that an up stochastic. I know it's a little bit nuanced. All right, now the weekly is saying to us, let me get rid of the stochastic here. The weekly is saying to us that here's our support, that we're likely to sort of step up a little bit and then prospectively push back down towards this 15 area, and then, which remember, this was the 382. This was the 382 of the entire rise up, and our weekly was arguably still down, but there's going to be buyers lying around because our monthly was still up. Do these multiple time frames just confuse the daylights out of everybody? Or does this kind of logic make sense? I know it takes a little bit of following, but I feel like if you can master the longer term time frames and then whittle those down to building shorter term trade plans, you've really got a huge edge. And you can see what we're doing is we're forcing ourselves to look at the future and say, right, where do we expect to be selling and buying? And immediately we said, okay, right, we're going to short here, short term, prospectively buy here on the medium term, and then sell through here on the long term for a long time. So you're building trade plans that you're buying and selling with very limited risk for a certain amount of time at these extreme zones. And I do nothing in between here. Not a thing. I'll only wait and buy at these extreme zones. So there's some times where I'll wait on a currency 3 months to do a trade, or 2, or 5. And then I'll build a $2, $3, $4 million position in these different spots. That makes sense? So if we look at our weekly pivots this week on the euro, weekly central is at 1860. The 4 hours a little bit down. And weekly M4 is up here on 2050, and R2 is at 2090. Okay, so let's. And the reason I mention those is it's where, from a pivot standpoint, we'd expect things to roll over hypothetically. Weekly R1 is at 2020, and last week was a pretty big range on the euro, so the pivots are a little bit wider this week. Remember that pivot points are calculated on the previous year week day or previous year month day. All right, so if they're crazy, if the range on the previous week is crazy wide, then the pivots will be affected, their calculations. So sometimes you have to moderate them down based on the previous range and the surrounding volatility, which has been overall pretty low. Currency volatility is very low at the moment, which tells me that 2018 could be a cracker. We just do, right? I mean, the VIX, what's it trading at today? Little tangent here. Yeah, it's trading at 987 right now. Very low, guys. Very, very low. A lot of complacency there. Anyway, let's get back to this euro. So let's cruise to 4 hour very quickly. 4 hour stochastic hard down. So daily up, this is clearly in a little uptrend on a short-term daily basis, but we're running into that long-term resistance with the weekly chart ultimately pointed up, but the with the weekly chart ultimately pointed down, but the daily chart pointed up. So our weekly central pivot is 1860, which also happens to be these little highs. So I think it's likely that we're going to do this on a 4 hour. Step down, because our stochastic would likely do something like this, kind of tick up and then double cross down. I think that we make it a lower high at 1920, push down towards 1840, which is this resistance support. Okay, that pushes up because the daily stochastic is up. That pushes us up towards that 120, 20, 120, 40 area, which happens to be our weekly reversal pivots. And then this, because the weekly is down, takes us down to around 1520. All right, so my trade plan on this was shorts, to build shorts between 1980 and 2040. With a target of the mid-15s in mind. And I think that this could be a very bumpy, ugly sort of ride. But I'm trying to make, the better part of 400 pips there. And I don't necessarily want to see it break 2060 with any kind of vigor. I don't trade with stops. Probably shouldn't say that. We'll just make that our little secret. So this was my short-term trade plan. Okay, so the short-term trade plan, sorry, for the next sort of 30 to 45 days was a short between 1980 and 2040 with a target of 1580 in mind. Ultimately I'd like to see the euro kind of push a little bit below that, because I think that there's, I would love to get long closer to 1450, looking for 123. All right, and then my 90-day plan was exactly that. A long of, 115. And because, here's the thing, because I'm taking it down, even though I'd exit the short closer to sort of 116 or late 15s, it doesn't mean to say that I would just flip the position right there. That's not how that works. I would absolutely just wait a while. It's very difficult for me to switch my brain from being short for 3 weeks to all of a sudden go, okay, I'm long now. Just because I want to exit the short doesn't put me long, if that makes sense. I get asked that question a lot. All right, so the 90-day plan would be 115.50 to 14.70, long with a target of 123 in mind. Okay, and then the 6-month plan is short from 123 to 24, looking for something around 110 with a target of 110. And then the very long term, which would be sort of the 2-year plan, would be, 110, and all these things get to 107, and all these things get revised a little bit. The longer term ones become a little bit clearer as time moves forward, right? But this would be a 110 long looking, or 110 to 107 long looking for close to 130. I just think that the Fed, and that's my 2-year plan, I just think that the Fed is just gonna string us along. They're gonna be like that girlfriend that will just never really commit, but you just tag along because she's just her. It's just kind of her, and your friends are like, why? And you just don't have an answer. So, to sum up, we've almost chewed up our whole time. Short-term plan, 1980 to 2040, looking for 1580. Medium term would be a 1550, 1470 long, looking for 123. And then 123 short, looking for 110. And then 110, 107, looking for 130. Ultimately, this is obviously my long-term fundamental bias. I think that the euro will recover relative to the dollar, at least into the 130s over a 2-year period. But I think it needs to visit something below 110 to be able to have the mojo to be able to get up to those areas and get enough people involved. All right. And I think that, I think that this wave of dollar strength, so that would be sort of on the pound, that would look like a 140 down to say 125. That phase, that 1500 pip drop, would probably see the likes of Bitcoin, really, really, really drop. Maybe from 12,000 to like 6,000. Even though it's a moderate move on the currencies, that wave of dollar strength, that little Ponzi scheme is going to come unglued. Something to think about if you're holding onto Bitcoin and thinking this is a gravy train. Are there any questions about this euro situation? So we looked at the monthly chart, we looked at the fundamentals, then we looked at the weekly chart, we looked at support and resistance on both those time frames, we looked at a little bit of oscillator stuff, and then we drew it down to a 4-hour, and we looked at 4-hour price action, we looked at support and resistance zones, we looked at the pivot points, we looked at Fibonacci on the weekly, and then we related that to what we could prospectively see this looking like. And you know how people will say, you're trying to predict the future. Yes. That's the job. That's the job. Predicting the future. So the whole idea is to be able to look at it and project out and say ahead of it, say where can I buy this, or where can I sell it? And ultimately, what your bias is less important than where you're committing to doing what you're doing. That's more important. It's just about being able to, and none of these, I think you'd agree that none of these areas are not support or resistance. That's very poor English, isn't it? None of these areas are not, that's double negative. But what are our areas? Let's go here to the weekly. We're saying to ourselves, zoom out. We're saying to ourselves, on the short term, this is resistance. Here's our short-term support. On the long term, we're saying, here's our resistance, and It's this down trend line, and it's also that stuff to the left back from 2008, 2011, 2012. And we're saying to ourselves, right, where's the next support? All of this. So all that we basically, and we got fibs through here, remember? 50% of this whole rise. So all we're saying to ourselves is, here's our resistance. Here's how we're going to bounce around. That's all we're saying. And ultimately, the bias is less important than the execution in terms of this because it's a little bit rangy. But at least you're waiting for resistance, support, resistance, support, resistance. And you look at this and basically saying that's a little base out. Our trend is going to grind very slowly to the upside based on our longer term fundamentals. And how will that look? And I know we've just covered the euro, but this is the detail to which I always try to structure my trades on every single currency pair. And the same, the pound is a very similar animal. I'm a little more bullish on the pound because I think the Brexit thing will resolve itself. And I think if you look back, sorry, there's a lot of lines on that. I think if you look back and you can see how I've written, you can see how I've tried to structure these trades anyway. I do one webinar a month. This is for my benefit. I've got nothing to sell you. I think that the Brexit thing will figure itself out. And I think if you said to yourself, we'll finish up here in 1 minute. If you said to yourself in 2 years, do you think the pound would be closer to 160 or 120? I'd have to probably say close to 160. Is 120 cheap? I think so. And if you look at it in broad sense, we lived in that 140 to 170 range, peaked above it, used it as resistance, and then we kind of lived in that range again. Yes, price went above it and spent some time above there, and now we've spent some time below here, and I think we'll do that again. But ultimately, popping back up into that range, I think is where it's a little happy zone. So same sort of thing here. Step up, stochastics up on the monthly, push down, make a higher low, breaks it, figures itself out, and then it grinds its way back into the zone. And then we live in that zone for a while. And the same sort of thing appears. So, my thinking on the pound was, short through those mid-30s, buys on the low 20s. And everything in between is a little noisy. Weekly still down. So weekly down, you'd like to see a step down towards 129, a push up towards late 30s, and then, something really down into the early 20s before we do that. All right. If you have any questions, feel free to email me, c5davidpegler@yahoo. Type it here in the room. Or my Twitter handle is @ForexDavid. So thanks everybody. I hope you picked up a little something. If you have any questions, shoot me an email. I've got nothing to sell you. I'm just somebody trying to make some money out of trading just like you are. And I wish you all the best, and we'll see you next week. Thanks for participating. And I apologize for canceling yesterday. I wasn't feeling great. I had a cervical fusion done about 3 weeks ago, and I'm still trying to get myself moving again. Okay. And I'll see you around Christmas time, I anticipate.